the 1973 gold bottom in the context of central bank gold buying and selling. Now, if you are among the crowd that believes that central bank gold buying is very important and central to the gold price action, you're going to be surprised by what I'm going to show you in this video, and I believe it is incontrovertible empirical proof that central bank gold buying and selling has very little to do with the price action, with trends, with where gold is going and where it is going to go relative to the reserve currency, which is the US dollar. There were two things that were happening around and on the very day of the 1973 gold bottom, which took 6 months to form from the previous top and was followed by a 100% rally over the next 4 months, mainly 2 months, January and February 1974. But after you see these charts and this data from a Fed paper in 1973, I think you'll agree that I'm right on this. And then I'll conjecture, I will speculate based on Austrian school logic why it is that central bank gold buying and selling has very little to do with the price. I'm not saying it doesn't affect it at all. It probably does in a very short term. But because the motivations of central banks and private people who buy and sell gold are very different, that's why I believe that central bank gold buying and selling has very little to do with the trends and the price of gold in dollar terms. Anyway, before we get into the interesting data around central banks and gold in 1973, 1974, you can support this channel by checking out Monetary Metals, link in the description below. If you open an account with them, you can earn interest on your gold and silver in gold and silver terms. And if you don't want to do that, you can always take some of your gold and silver and put it in a dirty man safe. Use the code ENDGAME10 at checkout for 10% off. Check out the link in the description below. And if you are interested in religious lessons on money and economics, then check out the Patreon for as little as $3 a month just to keep out the trolls. The last subject we did was how we know that God hates big government and hates fans of big government as well. Proof from Isaiah and Proverbs. Anyway, let's get to the Federal Reserve. 1974. Before we get to the Fed itself, just a review of the 1973 action in the price of gold. We topped here at about, $126. In May 1973, we fell for about 1, 2, 3, 4, 5, 5.5, 6 months at a low of $90.50. Well, according to the New York Times, it's about $86, so it's slightly below this. But this bottom took place on November 15th, 1973. What exactly was going on around that time, and specifically on that day that caused or preceded immediately a humongous 100% rally in the gold price from $90.50 to about $175, $180 just 4 months later. The bulk of this rally took place in January and February 1974. Well,
to understand why that date mattered, you've got to rewind to May 1973, when gold peaked near $126 an ounce before sliding steadily down to around $90 by mid-November. But here's the thing. Weeks before that bottom hit, the U.S. Treasury had officially revalued gold by roughly 11%, adding over $1 billion to the books. That was almost purely an accounting entry, though. No new money had actually entered the economy yet. It wasn't until the Treasury actually started spending those funds between late October and mid-November that the increase began feeding into the broader money supply. That's the monetary backdrop the November 14th announcement landed against, and what happened next makes the puzzle even sharper.
The first cause, and I will call it a cause, was gold revaluation by the Federal Reserve in October 1973, a few weeks before the bottom. But why was it on November 15th exactly? Well, we'll get to that in a second. Let's read this Federal Reserve paper together and reclaim the rainbow symbol for what it should be. This is a very titillating magazine called Federal Reserve Bank of St. Louis, January 1974 Review. Whoa, that's hot, baby. Okay, let's go to page 4 in an article entitled The Monetary Economics of Gold by Albert E. Berger. You can tell he's probably a very nerdy economist who doesn't have any idea what he's saying because he's a mega Keynesian, but at least he's writing about gold. I'm not sure if he's still alive. I doubt he is, actually, because this was 52 years ago or so. So we have here on page 4, October 1973, change in the official price of gold, right? That means a gold revaluation, devaluation. I know a lot of people believe that the gold standard ended on August 15th, 1971 with Nixon's closing of the gold window, but no, gold was revalued twice after that, up to $38 and then up to $42.22 in 1973. And this was the last revaluation of gold from $38 to $42.22. And that was around the bottom in 1973. But this is gonna shock you. So, October 1973, change in the official price of gold. In the week ended October 24th, 1973, following congressional approval, the official dollar price of gold was again increased, this time by slightly over 11%. The Treasury gold stock, which had been officially valued at about $10.4 billion in the previous week, was now valued with the new official price of gold at about $11.6 billion. The official dollar value of the gold stock rose by about $1.2 billion. Okay, then what happened? The U.S. Treasury, again, as in May 1972, had a choice of actions: either neutralize the effect on the monetary system of this increase in the dollar price of gold, or monetize the $1.2 billion and use it to pay for goods and services, hence increasing bank reserves by this amount. So he's saying, if the Treasury decides to take this $1.2 billion that now belongs to the Federal Reserve and spend that money into the economy, well, then that would be inflationary. But if they don't, then it's not. Well, what did they decide to do? What do you think they decided to do? Of course you know. In the week ended October 24th, 1973, this was 3 weeks before the gold bottom of 1973, mind you, the dollar value of the gold stock rose by about $1.2 billion, and Treasury cash holdings also increased by $1.2 billion. At this point, there was no net effect on the monetary base. Why? Why is that? Because they hadn't spent the money yet. It was just an accounting entry that equals $1.2 billion more, but since that money isn't spent into the economy, it hasn't bid up the prices of goods and services, therefore it is not inflationary. On October 25th, the next day, the Treasury issued gold certificates to the Federal Reserve banks, and Treasury deposits at the Federal Reserve banks increased $1.2 billion. Fine, this is also an accounting entry. Thus, the increase in the official value of the gold stock was monetized, or in other words, was available for the Treasury to use to pay for goods and services produced by the private sector. So they still hadn't decided to actually spend it yet, but now they can if they want to. Still not inflationary. The monetary base has not been affected yet. So far, there has still been no net effect on the monetary base, says Berger. Then, over the 3-week period from October 24th through November 14th, the day before the gold bottom of 1973, as the Treasury made payments, Treasury deposits at the Federal Reserve decreased by $1.2 billion, and deposits of the public, the monetary base, and bank reserves were increased by $1.2 billion. So they spent the money into the economy from October 24th through November 14th, but then something happened on November 14th that precipitated the gold bottom.
Central banks didn't just get permission to sell in 1973, they actually sold heavily for the rest of that decade. And yet 1974 through 1979 produced the strongest percentage gains gold has ever recorded in a single bull run. The same pattern shows up again in the 2000s. Gold's historic bull market from 2001 onward played out while central banks stayed net sellers. Heavy central bank buying didn't even resume until 2011, right as gold entered a 4-year bear market. So if buying drove prices up, these decades simply shouldn't exist.
We have this article from November 15th, 1973, the day of the gold bottom, from the New York Times. Price of gold drops in Europe. Well, yes, it does. This is the very end of the 1973 correction. What was happening on that day? Paris, November 14th. The price of gold dropped sharply in Europe's financial centers today following the disclosure of the termination by 7 nations of an accord barring bullion transactions by monetary authorities on the free market. The decision, theoretically at least, cleared the way for potentially massive offerings of the metal. Central banks still control half the gold mine since the 17th century. This prospect led to a $7 an ounce fall in prices in London and Zurich, the two major open market centers. Shares in gold mining companies also fell on European and South African stock exchanges. Bullion closed today at around $90 an ounce after reaching levels as low as $86 in hectic dealings. Last July, during a monetary crisis, the metal had reached a record of more than $125 an ounce. While there were conflicting interpretations of the termination agreement, the preponderance of opinion was that it meant a reduced monetary role for gold. The participants, the United States, West Germany, Britain, Italy, Belgium, the Netherlands, and Switzerland, in effect declared their right to sell gold in the markets if they chose. The question of gold purchases is still open, with the United States position declared, but others less certain. So what exactly happened on November 14th, 1973, that immediately preceded the gold bottom of November 15th, 1973, and that was central banks, the major central banks around the world, declared their intention basically to sell gold at free market prices, which they were not allowed to do until that was passed by whatever body was passing it, whatever super electoral or non-electoral body was doing it, some bureaucrat, some deep state thing. But they decided that they were going to do it, and they started to do it. And we see evidence that they started to sell gold. Central banks started to go sell gold that time, November 1973, for the next 6-7 years. And how do we know that? Central bank gold buying doesn't matter in terms of the price. I know people wouldn't want me to yada yada central bank gold buying, but I am. And how do I know this? Well, this is from gold.org, a graph of central bank gold buying and selling since 1950. So you can see from 1950 to 1966, central banks were buying gold hand over fist, and it wasn't affecting the gold price, obviously, because we were still on a gold standard at that time. Then 1966 and 1968, central banks were trying to sell gold in order to keep the London gold pool alive. Now, yes, the central bank gold selling did affect the gold price by attempting to keep gold in line with the $35 statutory rate that it was. So I'm not saying that central bank gold buying does nothing. I'm saying it doesn't really matter in the scheme of things. And then we see here that I boxed in 1974. That's the first box over here. That's when the selling started. 1973, there was no action in gold at all in central banks, in the big central banks. But then 1974, remember, they changed the rule in November 1973. 2 months later, they started the gold selling. 1974, 75, 76, 77, 78, 79. That was still the biggest gold bull market in history by percentage. And it coincided with massive gold selling by central banks. And because the bottom in gold happened at the very time that central banks declared they were going to sell gold, that's when the price started to skyrocket. The gold bull market began in 2000, 2001 in the face of huge amounts of gold selling. And the gold buying only started in 2011 when the gold bear market resumed from 2011 to 2015. So really, from this chart, there's almost an inverse correlation between central bank gold buying and selling. I wouldn't say it's inverse. I wouldn't say it's a contrarian indicator or anything like that. I'm just saying it doesn't really matter in terms of price trends. Now, the question is, why would that be? There could be a lot of reasons, and I'll give you one that I'm thinking of that has to do with Austrian school logic in terms of value schedules for individuals. Now, when an individual buys gold, especially in the hyperinflationary phases of it, he's not really buying gold. He's getting rid of dollars. So it doesn't really matter to him how much gold he gets for those dollars. He's just trying to get rid of the dollars. And if that's all he can get, that's all he can get. That's in the ultimate apex stages of hyperinflation. But even in normaler times, a person buys gold because he's trying to preserve his purchasing power, because he wants stuff. A central bank, why do they buy gold? They buy gold because they want to inject the economy with a bunch of liquidity. They have to print dollars to buy gold, just like they have to print dollars or any other currency in order to buy whatever it is they're buying. And when they sell gold, what are they doing? They're trying to drain liquidity from the market. So how many dollars they get for it doesn't really matter to them. They're going according to an equation that somebody made up in econometric class 101 of how to be a Keynesian. So they're not really making a decision about their own purchasing power that they want to reserve. They're trying to manipulate their liability notes. It's not really an economic actor there. These aren't people making selfish personal decisions about their own purchasing power and what they want to do with the value of the work that they have invested all of their lives to create. We're talking about econometric nerds who are going after theories or following theories that make no sense because you can't reduce human action to constants or put them in an equation, according to Austrian school logic, which is actually correct. And so the succinct way to put this is that a central bank, or central banks in total, are not really economic actors. They have no interest in preserving their own purchasing power as individuals or even as institutions. They're trying to rescue credit by manipulating its price relative to gold according to equations that aren't even real. When a central bank sells gold and tries to lower the gold price, it ultimately depletes the backing of whatever credit they still have by reducing the amount of gold on its balance sheet that backs those liabilities. And so longer term, selling gold weakens the credit and strengthens the gold price. Whereas when a central bank buys gold, they have to put more credit into the circulation, into the banking system in order to acquire that gold. And that weakens credit relative to gold and increases the gold price. So whether you want to look at this globally in terms of logic as an economic actor, or you want to look at it in a microscopic way as to what is the mechanism of a central bank buying and selling gold and why selling gold will increase the gold price by decreasing the backing of the liability notes that they call currencies or credit, and why central bank buying gold will decrease the gold price by increasing the backing of the credit relative to money. Either way, central bank gold buying and selling is really not what we should be focused on. It's about individuals assessing their purchasing power and deciding whether they can rely on the credit notes of central banks.
None of this erases what's happening right now. Sovereign gold buying has been genuinely massive. Purchases have topped 1,000 tons annually for 3 straight years through 2024, and gold's overtaken U.S. Treasuries as the world's most held reserve asset. But the 1973 case study is a warning against reading those headlines as a price forecast. And if this pattern holds, the more telling signal isn't what central banks report buying, it's what millions of ordinary people, quietly and individually, are deciding their own currency is still worth.